Hello and welcome to another episode of Monday Markets. Hope you're all doing well. Let's talk about the markets because they have moved. First and foremost, the market is now trading above 20k. I'm using that quite liberally, 19.3, 19.5, however you want to define it. The more important point is that we had this multi-month summer range. It broke down on the news of FTX collapsing, and the market is now trading above that. That's a pretty big deal, both in terms of technicals, but also just like narrative and optics. That's definitely, in terms of list of hierarchy of what's important and what's a big deal, that kind of reclaim is definitely top of that list for my money at the very least. Now, in the short term, there is weekly resistance here in the form of the top of the previous range at around 21k. I just think, again, if you take that hierarchy in mind in terms of what's more important, the 20k reclaim or the first weekly trouble area at 21k, I think for me, 20k reclaim takes precedence over that. That doesn't mean you have to ignore short-term levels of resistance. You still have to use them to kind of trade and know where you are. But I think sort of in the short to medium term, the 20k reclaim is simply more important. So that's kind of where my mind is. I also would argue that it presents a fairly clear line in the sand in terms of levels for short to mid-term directional bias, that anything above 19.35, 20k, whatever, looks pretty constructive, and anything below that starts to look rather disastrous. So those are kind of the two operating assumptions for this video. Now, I think most of our useful information will be derived from the daily time frame as ever. I mean, the weekly, as I said, the most important thing is the reclaim. Fine, great. And then, as we've covered in previous videos, in terms of first trouble areas, I think you can quite reasonably just map out all of the previous swing highs and see where the market goes and if there are any stitch ups or whatever else. And obviously in validation, given how important 20k is, anything below there starts to look really bad. So look, just like on the daily time frame, as you'll recall, last time we spoke, the argument was that, and this is for several weeks beforehand, just during the course of this consolidation, apologies for the sticky keys, that the market's consolidating between 16 and 17.6. We already had a breakout attempt at 17.6, 17.7, and a second failed breakout attempt is far less likely. So when the market closed above it, boom, you got your acceleration. So hopefully if there's one thing that's been useful or that you added to your chart books, is the whole premise of double failed breaks are quite rare. Let us know in the comments if that's something which you managed to catch or that's helpful to know in the future, because this is a very kind of recurring pattern in crypto markets and one worth being aware of. With that context in mind, the final note for the weekly, I think that's why this kind of 20k level presents a decent line in the sand as far as directional bias goes, because we've already had a failed breakdown at 19k, right? You had support, 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 breakdown, reclaim this week, or last week. So if the market fails 19k again, it would essentially be the bearish version of what happened at 17.6. We already had a fake out at 20k. If it happens again, it's probably going to be a real move and, you know, expecting momentum continuation to the downside. That's why I think both kind of psychologically, technically, narratively, what have you, this kind of 19.3, 6, 20k, whatever summer range is such an important level and a line in the sand for directional bias. As far as the daily time frame goes, again, the move has played out from the 17.6k breakdown, closed above the fake out level. Don't know why my voice cracked there. Puberty is very exciting. And then just moved higher. I think it's important now to shift your focus to where is the market trading at the moment. It's very tempting to just live in the past and think, oh, this was such a big move, or I missed this, and it got there so quickly, I don't know what to do, I'm going to revenge short, all that type of stuff. I would cast your mind away from that and focus on the available evidence and the structures we have to trade for the time being. And for me, there are really kind of two ranges to work with. I think we've mapped this out on previous live streams, if not last week. So essentially, on the daily time frame, we have a tale of two consolidations. The first is the one that we broke out from and the one we came from. Again, this omnipresent range you'll be very well acquainted with as viewers of the channel. 16k range low, 17.6k range high, and then we've obviously broken down from that, or broken out from that, I should say. Freudian slip. Where did we end up? We ended up trading back within a previous range. This one was also featured on the channel for some length. 22.6k range high, 19k range low, and a 20.7k range midpoint. So in terms of where the market is right now, it's trading at the midpoint of the 19k to 23k range. And that's following a break and close back above the range low. So generally speaking, when you have a range, as you'll know, So these are our boundaries. If the market reclaims the range low, your first trouble area or target is the range high and a potential don't diddle in the middle type of pivot point at the range midpoint. So given we've already reclaimed the range low, the logical target for that type of extension is ordinarily the range high, which for us is 22.6. Now, the tricky thing is, the market's currently trading at the range midpoint, and you'd be completely forgiven for arguing don't diddle in the middle because that's generally bad advice. That the best range trades come at the extremes and not at the mean, and that's completely fair. However, I would argue that on this occasion, you might be forced to, if you're looking for that continuation into the range high, to do business in or around the range midpoint. Now, that's not to say that if the market pulls back to the range low, that you should ignore that area or it's a bad area to do business. I do think any kind of 19K pullback type of stuff, purely from a technical point of view, I will be looking to trade that for a bounce, because you basically have mega support, failed breakdown, trades back above. I mean, this is just kind of very textbook range low plus confluence and a bunch of other stuff. So if the market during the course of this week or before the next video, fails at the range midpoint and starts drooping lower, the first area to play for a bounce would be the range low. And just like the breakout of this consolidation led to the next one, in a worst case scenario where 19K fails, you simply apply the same logic in reverse, where if the range low at 19K fails, then you have to target the previous consolidation of 16 to 17.6K, and things would look pretty ugly at that point, but it's worth bearing in mind. So yes, any pullbacks to the range low I think are tradable for a bounce. Any acceptance below that, well, then you have to work with what we've got at much lower levels. And also the chart would look pretty disgusting at that point because it will have fully retraced its momentum. I don't think that's terribly likely at the moment, but just kind of know what to expect depending on how price action develops. Now, we've kind of accounted for directional bias levels, what happens if we get a sharp pullback to 19K, potential type of worst case scenario, whatever stuff. Now, what if we simply subscribe to the argument that the range low has been reclaimed and the range high is the target for that? Now, if that's a reasonable premise, how would we get on board that type of idea? Now, again, the first way, as I mentioned, is just simply range low and then maybe to range midpoint to range high. But that in itself, while being a fine idea, would start to look pretty precarious with, a lot of this momentum retracing in the short term. What if it doesn't retrace and it's just kind of, instead of doing the immediate breakout retest up, what if it's one of those impulse consolidation impulse type of legs? How do we trade this? And that's where I think in some exceptional scenarios, including this one, paying attention to the range midpoint might actually pay dividends. And that's sort of the focus of this video as far as Bitcoin goes, because I think if this is going to have another leg higher, it will, in a way that's not sort of fantastically scary full retrace type of nonsense, it'll likely originate from the range midpoints. We need to set our expectations for potentially trading it. Again, if you take at face value the premise of impulse consolidation impulse, and with the impulse target being the range high, the consolidation will almost necessarily happen around the range midpoint. So having some sort of plan to engage with it if you want to catch this leg and potential further extensions, that you almost sort of have to be ready for it. Now, what might that look like? Quite simply, for me at least, the way I've mapped it out is I've got the range midpoint at 20.7, and I'm willing to also add a level in confluence of that at 20.3. And if you kind of take it back a bit further, you can see that's a former range high, high, low, final breakout before the nuke. It doesn't really matter. It's more or less confluent with the range midpoint. And then you can just simply draw a zone or a box or whatever you want to have that as your midpoint pivot, which I think is quite reasonable. And then the statement becomes that if the market is going to continue higher, the first reasonable area to look for continuation after consolidation is this combination of 20.7, 20.3. Again, let's say you get some sort of long setup here and it pukes. Well, then the do or die setup becomes at 19K, and if that fails, then bulls are invalidated and you have a very clear directional bias. So really, if this market's going to be anything other than a piece of garbage, the only two plausible ways it can do that is in or around the range midpoint, or the worst case disaster scenario from the range low. There's nothing really else that makes a ton of sense, and that's why I think you could even bias towards both and say I'm going to try to get some sort of continuation setup at the midpoint. If it fails, I'll have a final attempt to buy strength at 19K, and if that's not good enough, well then I'll just sell it to basically zero, and that's kind of what makes sense. Now, in terms of this consolidation, again, these videos are quite tricky to make because they're on a weekly basis, and this stuff might change day to day or whatever else. And look out for Twitter or our newsletter or other pieces of content to keep you abreast of those changes. if this is going to, the most bullish resolution to this, as I mentioned, is that this is the impulse going to consolidate around the midpoint and then go up. That's kind of my base case in a very sort of very loosely held, but it wouldn't be terribly surprising. At the very least, I want to be prepared for it. Now, what might that look like? Well, first of all, on the daily time frame, if this consolidation continues, then our normal sort of daily time frame trading stuff is applicable here. So, for example, if tomorrow is an inside day, that is to say the price action of tomorrow is contained within this daily candle, then you can look for a standard type of inside day failure where, for example, the market on the next trading day spikes the previous day's low, gets bought up and closes above it. That gives you a sense of invalidation, and you have the added benefit of having a higher target towards the range high. It could be a failed breakdown at the range midpoint. So, for example, the market starts to look pukey, spikes through, and then closes back above or gets reclaimed later in the week. Again, that's something at the range midpoint that gives you a very clear invalidation and the same target in the form of the range high. All of those can also be expressed on intraday timeframes, whether that's a failed breakdown at the upper boundary of the range midpoint that then gets reclaimed, or a deeper spike through all of the lows that doesn't get accepted and trades back within the midpoint. Anything of that nature, I think is, as long as it's risk defined, which is what all these squiggly patterns, lines, things have in common, is that they're risk defined. You have a very clear invalidation for doing business at the range midpoint. And I really think that's the most important thing. So as long as you get something like that, some sort of lower time frame or even daily time frame risk defined bullish trigger at 20.3 to 20.7, I think that's at the very least worth exploring, because if the market doesn't pull back, that's going to be your only reasonable avenue to moving towards the range high. So whether that's just normal pullback stuff, normal price action, failed break, whatever, I think in any case has to originate from the 20.3, 20.7 level as your invalidation. And look, if you have to use a wider stop on the daily, that's fine. If you get something intraday that allows you to define your risk more tightly, even better. But I do think it's a reasonable midterm pivot to consider, because otherwise, if the market does go to the range high, your only option becomes buying it at the range low, which is a fine option if it gets there, but at the very least, as a fail-safe, precautionary type of thing in the back of your mind, I think it's worth planning for an impulse consolidation, impulse type of thing, so you're not totally caught off guard should the market continue. And I think this also applies to bearish ideas, which again are completely reasonable at the right spot, but even if you're bearish, you'd have to be bearish diddling in the middle, which isn't terribly attractive. Certainly if you're going to fade large impulsive moves, you want to do it at the extremes. And the extreme, by definition, isn't at the middle, it'll be at the extreme, which on this occasion is the range high. So that's also worth bearing in mind. I really think that's the only kind of point I have for BTC. Not much to add. I mean, let me know if you've got any questions, but I think it's rather straightforward. Just as a recap, if there's some sort of doomsday nuke, 19k is the last port of call for any type of reasonable bounce, because after that the weekly starts to look garbage and the whole thing starts to collapse. I think in my estimation, sort of back of the napkin maths, and if it's going to continue higher, an impulse consolidation impulse pattern is much more likely than impulse full retrace then higher high pattern. I prefer the first one to the second one purely in terms of probability. I think if you do get the impulse consolidation impulse, the consolidation bit is likely to be between 20.7 and 20.3, and then you just have to take out your price action toolkit, which you hopefully have developed from watching these live streams, watching the cred videos and whatever, to try to get on board in a risk-defined manner should the market set up appropriately. And again, I don't have crazy extension targets or anything like that. I think if you're reasonable, it's worth taking this consolidation and just this kind of price action one level at a time. And for me, that's the 22.6 range high. And I also think the 200-week moving average is there and a bunch of other mean reversion stuff that I wouldn't ignore at the very least. So that's kind of Bitcoin. Hope that makes sense. As far as ETH goes, on the weekly time frame, it actually blasted through the 1400 potential lower high level. So again, the similar to Bitcoin, it did, we've got the 1.3k breakout and now the 1.4k reclaim as well. I think those are important. I do concede, of course, and it's worth being aware that there is resistance at 1590, 1600 in the form of the former range high, and that's worth respecting. But I think, again, in terms of priority, the 1400 reclaim and just the size of this impulse, those two things slightly outweigh that. Now, what that leaves us with And unfortunately, on the daily time frame, the range, you can't sort of slice the chart up into two ranges like we did for Bitcoin, but there are still good levels here. And again, as you'll recall, 1400 I think is still a good level. It does look like it's been chopped through a shit ton, but I think even if you look at it on the daily time frame, there's still enough going on there overall to make it worth your attention. So as far as ETH goes, I think if there are going to be any type of dip scenarios, at the very most, it would have to hold this consolidation, sort of 1460, 1420, the 1400 level, in one shape or another. Support, bunch of chop, but it is the prior all-time high. I still think this level is likely to do something, at the very least on a reaction point of view, if the market does pull back. In terms of daily structure and all this other stuff, I'm having a much more difficult time with it. I'm potentially open-minded to using this lowest close as a midpoint consolidation equivalent for ETH, so around the 1500 handle. But if I were to do that, it would be with much lower conviction. I think it's fine as a kind of, if the market's going to do this, essentially, the question is, where is this? Or what's a decent anchor for that? I'm kind of okay with it being 1500s, but the same considerations would apply. If you get like a failed breakdown or something that gives you something a bit more risk defined, that would be preferable. I'm like maybe 6 out of 10 on using this as a pivot. It's just one of those things where Bitcoin has a very clear pivot from where this could continue if it's going to keep impulsing, slightly less so for ETH. Fortunately, I think the first trouble area for ETH, if it does continue higher, is similar. It's just the highs of the last big rally, which is around 1600, 1700, this double top, just to kind of see what happens there. I don't love this area because if you just look to the left, this whole thing was pretty messy in terms of structure. There really wasn't particularly clear to trade. So I'm just going to focus on swing highs and swing lows more than anything. But I think that leaves the ETH idea. If you understood the Bitcoin part, which hopefully you did, or I just wasn't clear enough, which, if I wasn't, leave me a comment. But it sort of leaves us with a similar decision tree, which is if you want to be really aggressive, continuation has to come from basically 1500, 1515, 1514, whatever, basically the low set around the previous 2 days, and what shape or form that takes is to be seen or to be decided, but the basic idea is that this consolidation in one form or another is a precursor to continuation than not. And if that's incorrect and we get a deeper dip type of scenario, I think it has to hold 1400, frankly, because if not, then this just looks like a big wick and market structure still looks garbage and all of the above, basically. So 1400, under 1400, maybe at an extreme, we broke through this level in itself, but also the top of this entire value area also. And that lines up at around 1390, 1370. So, all roads lead to 1400 as a decently straightforward line in the sand for ETH. So hopefully that makes sense. As far as altcoins go, it's been a bit of a mixed bag with some outperformance and some not. Nothing that we spoke about last week has been sort of particularly compelling on those grounds. The only one that comes to mind is Solana on the weekly is at weekly resistance. So that's I think that might be one of the weaker ones, or at the very least, if you're looking for bullish continuation, that's not going to be the top of my list by any means. I can certainly see another push to fill in some more of this selling, but it still starts to run into structure around 26, 27, and you've got weekly resistance at 25s. So this whole area becomes pretty precarious. It could be a decent one to offset some of your long positions. If you think Solana's going to be weak and you have like core longs and you want to reduce some of your deltas across the board or whatever, or hedge, I think that might be okay, but I don't put those trades on particularly often. I think, I'm not going to try to sound smarter than I am. There's just a weekly level here, and a bunch of altcoins look like they've got a lot more space than this one. Again, I have a request for commentary from the audience. If you want me to add altcoins to this watch list, ideally ones that you like trading or have better price action and not just like a 1 week, oh, this is pumping, please talk about it next week, let me know and I'll add them to the watch list. But otherwise, I think Bitcoin and ETH are way, way clearer. And maybe if those break out or consolidate or do whatever else, we'll have clearer pullback levels on altcoins and a better map there. But they certainly have my focus for the time being. But again, do leave a comment on how we should expand this watch list. As far as macro legacy stuff, whatever goes, I don't think it's terribly relevant. And that's for two reasons. One is I think the crypto momentum is so large that the market will probably just focus on that for a while. That's not to say that something terrible in macro world won't impact crypto, but I just think these types of huge momentum moves kind of deserve their attention on their own terms, and will likely follow through. But perhaps even more importantly, there's nothing particularly scary on the equity indices front in terms of support, resistance, or technical structure. So the market is still above 3,900 and it's still above monthly support 3,700. Potentially we could start looking for first trouble areas. The first one is at 40.60, the range high. That's fairly conservative. The level I've seen a lot of commentators converge around is a bit higher on the weekly time frame. The overthrow level, I think closer to 4,300, is also being discussed around here. But I think the two levels which I've been using to get my view of the S&P 500 have been monthly 3760 and weekly 3900. As long as the market's above those, it's fine. That's not going to be terribly scary. If you wanted to macro FUD yourself for any reason, I think it would have to be dollar index oriented. As you'll recall, we were in the midst of a deep monthly cluster retest around 101, 102, and that's now reached the lower boundary of it at 101, which also lines up with the sort of highest close of this consolidation, the breakout level to some extent as well. So if there's going to be any pressure from the legacy world, perhaps dollar strength will do it. At the very least, it needs to get above the breakdown level at 103 to start being scary. So keep that in mind, but I do think this is at least one of those weeks or periods where focusing on the crypto price action will likely be more telling than the macro levels per se. That's all I've got. I don't want to keep this too long because I'm sure you're consuming a lot of crypto content at this time. Hopefully this was somewhat helpful. As always, let me know if these videos help. If what you think I've said is complete nonsense, that's also very welcome. And what altcoins I should add to my watch list. That's all from me. Hope you've all had an excellent weekend and see you next time. Bye-bye.